is episode 3 of Systematic Shenanigans with myself, Manir, and Pedma. We are both systematic/algorithmic traders, and we have a weekly conversation around varying topics, either within systematic trading itself or just around trading in general as well. Now, the previous 2 episodes have been super well received, so we're going to keep this going every single week. Please let us know if you have a topic or conversation you'd like to hear us talk about. But apart from that, let's get straight into this episode. All right. So for this week, my main notes I've got noted down is really about Bill Dunn. Now, if people aren't aware of who Bill Dunn is, he was a trend-following systematic trader, and I think he was one of the first, if maybe not even the first, if according to the facts. There isn't that much online info about him, so please come into this podcast, I guess, of us two chatting with that in mind. I've tried to get as many facts as possible, but I may be wrong on some things, but I think overall it's the kind of same sort of points. Now, for the first thing I wanted to talk about was, we actually mentioned this on the first podcast together, and that was around the 6-year drawdown. Now, obviously, it's a trend following approach, so if people aren't aware, traditionally in trend following, you're going to be having really large winners, and then you're going to have a long period of time of smaller losses for the most part. So it's a low win rate strategy, and you're trying to get high risk to reward on a couple of those trades that then pays for all the losses and more. And I just wanted to kind of go into the point of how I saw some people respond to a thread around Bill Dunn saying a 6-year drawdown means he's a bad trader. And I thought this was super interesting. So first, I wanted to get your perspective on it, Padma, and then I can kind of talk a bit about it myself as well.
Yeah. Calling someone that is trading for a few decades like a bad trader is always more telling of the person saying it than the actual trader himself, right?
Yeah.
You can see even from other trend followers in the space, even the old, like Jerry Parker, that is from the old turtle traders, you can see that they all have multi-year drawdowns. It's expected in that type of edge, let's say. But it's really hard. If you are trading, especially if you are trading clients' funds and everything like that, it's really hard to go 6 years on a drawdown. But the benefit is that you have a very robust strategy that has worked for a lot of decades, and that is not really correlated with the S&P 500, for example. And you have some diversification benefits there. It's just one strategy. It's not a bad trader. It's just the edge is not there at times.
I agree. Like, as you mentioned with correlation, at least according to my facts, apparently his performance is minus 0.06 correlation coefficient compared to the SPY, which is, incredibly impressive. For those that maybe aren't as aware, to get results with a negative correlation to SPY, especially, over a very long decade, is very difficult to do. That is definitely not like an easy feat to achieve, and especially as well as outperform it as well. It's like really impressive. But yeah, I agree with your first statement that for the people that were saying he's a bad trader because he had a strategy or his portfolio was in drawdown for 6 years is mainly very telling of how people view trading nowadays. People view trading as you have to be making 100% every single year. You can't have a down year. What is a drawdown? People don't really associate those with trading. People only see the highlight reels. People only see, hey, I made 50,000 this month because of this thing. Whereas in reality, most of trading, you have to deal with being in that drawdown, and it's going to be a recurring theme across all these podcasts because it's just the reality of what trading is. Like, most of the time, Pedma and me are in drawdowns. I'm never like celebrating at all-time highs all the time, and you can't view yourself as a bad trader just because you're in drawdown. That is definitely not how I would view it. And actually, a question I'll pose to you is, what to you would classify as a profitable trader? Is it 1 year of returns? Is it a couple of months of positive returns? What do you kind of view as what is a profitable trader?
That is a good question. Trading is very much like I would say fishing. Let's say you are waiting for a fish, like you are trying to fish, you are waiting for the fish to land. Sometimes on your spot, the spot that you are on, there will be no fish. Are you going to scream at the spot or at the fishes that are there that are not going to your to being able to be captured? No, you are going to wait. You're going to go there another day and wait for better seasons, whatever. I'm not a fisherman, but you get the point. It's like you are trading some edge. The edge or the effect or whatever, it's not going to always be there. There will be seasons in the market, and you are going to be, and it doesn't mean that you are a bad trader because you are in a drawdown. If the entire benchmark for your model is negative, you are also going to be negative. So it's not bad or good. It just means that whatever you are trading is out of season, and you have to realize that and understand it. In terms of what is a profitable trader, that's a hard question. At the very basic level, it is someone that makes money in the markets, right? But there's different frequencies to that. Like an HFT, maybe the PNL is important at the end of the day. Maybe for a trend follower, the PNL is probably important at the end of every 5 years or something like that. So it really depends on what you're trying to extract from the market, in my opinion.
Yeah, so from your perspective of the different types, I think that's actually very true. I think most traders, at least what I see on Twitter and probably even myself, I guess, would normally view if you are profitable, you'd normally have at least a year of track record. That doesn't necessarily mean every year needs to be profitable, but you would at least have 1 year where you have been profitable, and then you can kind of go on from there. But I do agree, probably the more accurate depiction would be, based on what you're trading and your strategy type. So if you're trend following, then it's going to be, a longer horizon. If you're doing HFT, as you mentioned, it'd be quite short, to be honest. But the one I would also say that's very important is I see a lot of people say, hey, I've beaten SPY this year or something like that. But I would say, to be honest, you won't actually know if you've actually beaten SPY until, for the extreme, it would be like 20 years. Because over that time horizon, you'd actually need to know if you've, completely beat it over that time, or if you just had one lucky year and then you went into drawdown, or you underperformed for all the previous years where it would have just been better putting your money into SPY, if that makes sense.
I was just going to add that even beating the SPY is a bad metric in itself, because I can beat the SPY tomorrow just by leveraging myself up 2 times, right? And buying SPY. And I've beat it, right? So it's not about beating SPY, it's about getting more returns for less risk at the end of the day, what we call risk adjusted. And if you can do that consistently over many years, not just 1 year or 6 months or whatever, if you can continue doing that, then you are let's say, I wouldn't say a profitable trader, because you can make 1 cent or $10 and you are profitable. I would say like a good trader. There's difference between a profitable trader and an actual good trader that does this for a living.
I definitely agree. Actually, realistically, I don't know what people take from this, but I think it's sort of a useless term to say if you're like a profitable trader, just because it really does depend on so many factors. I don't think you would ever really have two people, if as long as they're thinking about it kind of deeply, to agree on if they are profitable or not based on those sort of factors. I guess it's more important if you're just actually a full-time trader, or if you've at least dedicated time to trading. I do think having your first profitable year, I think, is a big milestone. So I think that could be something that you say you've achieved. You've had, one full profitable year of trading. Because before then, if you've just been struggling for multiple years or months, that sort of main achievement does separate you out to a lot of traders. Many traders don't even get to have a, significant profitable year. So I think that could maybe be one sort of line around it.
Yeah, definitely. But yeah, I think the conversation is, like you said, is more around if you do this professionally or for a living, or if you do this, if you are profitable for 1 year or whatever. That does The profitability part doesn't tell us much.
100%. For my next point around Bill Dunn is, I actually posted this tweet on Twitter, but I really liked it, so I want to kind of restate it here. Is he quotes, "I'm enough of a scientist that I overcame my emotion, and I said, well, let's just play it out and don't focus on the problem and focus on what we're doing right." And I think this sums up a lot of trading, in my opinion. Is a lot of the time I'll have people ask me, how confident am I on a backtest when I'm setting it live, to fully deploy a strategy. And most of the time I have to tell them that while I'm obviously convicted in my testing, I feel like I've done my testing correctly, end of day, I don't know if it's going to be profitable or not. I couldn't tell you, I couldn't even really give you a good probability of how much I think it'll be profitable. Some strategies I've deployed and they've been instantly into drawdown, and then they've kind of come back 6 months later. Some I've deployed and then they've been profitable and never really dipped from there. So a lot of the time you kind of have to just take on that risk and set it live and see what happens. You obviously need your conviction from all the previous testing to actually then have conviction to let it play out. But when you do deploy it, you kind of just have to be a scientist and say, here's my kind of hypothesis of what I think is going to happen, but let's just play it out over X amount of time, get enough samples, and then I can reevaluate from there. Because anything less is you're most likely just being emotional about that decision. What do you think?
Yeah, definitely. It's much I tend to say that in markets you are paid for uncertainty, right? You are paid if just think like this, like if the returns that you are getting, you make a back test or a simulation or whatever, and you think that, and you would know for sure that strategy would make money, and let's say that you would know for sure that you do not make better risk-adjusted returns than the S&P 500 or whatever benchmark you use, then why would you get paid for that? You are getting paid for free money to make money for free with no risk, no uncertainty, nothing. There doesn't exist that type of money in the world, at least in most cases, right? I bet there's some fringe examples, but in most cases, you are paid for risk, for taking risk, for uncertainty, for being better at predicting, let's say, predicting the future than the next guy. That's basically what you get paid for. If you are doing positional trading, there's other types of trading, but that's not the point. So if you want to remove that uncertainty part from trading, you really can't. That doesn't exist. You have to be able to take the variance, to accept it, and understand that we don't know for sure, but the best we have is estimates.
Couldn't agree more. It kind of goes back into like obviously the risk premium sort of topic, right? Like anything above risk-free rate is you're taking on a risk that others don't want to, and a lot of that is obviously that uncertainty as well.
Exactly. That's the concept for everything. It's just that if you think about it, you let go of the need to control everything. It's like you are getting paid for that uncertainty that someone else that knows maybe more than you doesn't want to take, and you are willing to take it.
I think that's kind of summed up kind of beautifully. For the next quote I kind of wanted to talk about was that it's very tempting to be driven by the immediacy, but you don't have any research on the immediacy, and you have loads of research and lots of the past. And I think a lot of times when we're taking strategy live and other people are kind of viewing how the performance is, a lot of the time they're trying to view it on a daily basis, maybe even a weekly or monthly basis. And normally you just need a lot more data to actually be able to get a sound idea of if a strategy is working or not, especially when you've set it live. I had actually a guy reach out to me recently, and he has said that he set a strategy live and it wasn't working for the first week, and what he should do. And ultimately I just had to reply with like, you just need more time. Like there's nothing I can really tell you with 1 week of data to say, hey, this is, obviously you need to change this and now it's going to be profitable next week. You have to be willing to sit in that, as we're kind of mentioning, uncertainty, sit in that drawdown and be able to hold out long enough to where you can then make a really good decision and kind of move on from there. And I don't know, I know these are very simple quotes, but more and more I kind of got into trading. I think a lot of these simple quotes carry years and years of experience summed down into a quote. And when you first get into trading, you see these quotes and you're like, oh, that's so basic. That makes no sense. Like, why would, it doesn't have to be that simple. But there is a beauty to it that over those years and over that pain, you come to realize that is ultimately the truth. There are some things you just cannot control. You have to be willing to, sit in that drawdown, for example, or be able to wait, months to see actually results. And that's kind of what you're getting paid for. If you had that sort of immediate knowledge and reaction to where you could make these small adjustments and then be profitable, as you've kind of mentioning, then it just wouldn't exist. Like that, it wouldn't be something that would be able to be harvested for like an edge.
Exactly. You can be a bit more, let's say, a bit more proactive, and when you are not sure about if like for example, that guy that was questioning his strategy for 1 week, benchmark it against other people that are running the same strategies. For example, if you are running a momentum model, let's say, benchmark it against other simple momentum models, a simple crossover or something like that, or the past 30-day returns, and test that strategy and benchmark it against yours. If that strategy is also going down, so your returns are also going to go down if you are exposed to the same risk factor, right? You can't force like returns out of the market. The market will give you the returns. And let's say that you don't know what you're exposed to. Let's say you have two options there. You either have alpha, which if you are making that question, I'd say it's highly questionable, or you don't know where the source of returns of your strategy is. I'm getting a little bit more practical here, but basically you just need to know where the returns of your model come from. And if you don't know, you should be working at that more than you should be working on your model or even trading it. You need to know what you're doing. And then once you know, you can benchmark it against other people that run the same models as you. And you will find out if the reason for the underperformance is you or is it the market. That's the only question you want to know.
I think that's very well said. I want to ask you one question. Would you, so let's say you deployed a trend following strategy, right? And
Yeah.
you are seeing better performance than others while they're in drawdown. Would you be worried about that, or would you be like happy to see that?
I would, it depends on the time frame. So if it's over many years, like we talked about, I would be happy about it. Maybe there's some signal efficiency there that I'm doing that others aren't, and so I'm able to extract a bit more returns from whatever I'm doing. If it's over a short period of time, it's probably noise, and probably I got my variation of my model got lucky.
Okay, I think I agree with that. I definitely think, yeah, I did leave out the time frame side of things, which I think I could have been clearer on with that question. But like sometimes I'll see people question their performance. Like, okay, let's just take small caps as a really easy example, just because I'm quite relevant with it. That people will say they're underperforming in small caps, right? And I'm like, well, if you look around, everyone's underperforming right now. Like that's kind of the standard. Like it's totally normal that you are. And if you're an outlier there, that doesn't necessarily mean you're doing the right thing, because at least from my experience, when you're taking across an edge that is sort of standardized in a method saying that, like, for trend following, we all know what builds a trend following strategy or a mean reversion strategy, right? You should be profiting in times that have trend, for example. And if you're not, and for some reason you're profiting during, range bound markets or something like that, that ultimately means you haven't made actually a trend following strategy. You've made some weird kind of concoction that maybe has just got lucky over that X amount of time. So I do think you're very right in saying that, like, if you look around you and see if similar people running similar strategies to you are underperforming or performing, it should be kind of aligned with yours to some extent. Obviously, now if you're running a portfolio and you have like uncorrelated things, then that goes into it, that you could have strong performance when others are not. But by comparing to others and seeing if that performance aligns, I think you can get a lot of value and kind of confidence in your system as well.
Yeah, and to me that comes down to the question around alpha and a beta, right? If you can't explain some portion of the returns of your strategy, let's say that you consistently beat trend returns, you are running a trend model, let's say, and you consistently beat trend returns by 10% or 20%. I'm exaggerating, but let's say, and you can't explain why, then there's some component of alpha there of unexplained returns that you can't explain, and you need to break that. I don't want to say you need. I'm just saying that if you break down the source of returns, maybe you can find out what's driving that extra return that you can't explain, and that maybe is alpha, or maybe not. Maybe it is explained by other factor that you are not aware of. But if you are going to make comparisons, at least on a directional level, for like you just said, like if all the other trend followers are performing and you are underperforming, and that happens a lot, then I would be concerned, because I should at least have some directional basis to what they are doing.
100%. Do you agree with the statement of like you should be able to explain your strategy in like 2 minutes, or like those sort of quote kind of tweets you see around saying if you can't explain your edge in like 1 minute or in like 10 lines, then you don't really have an edge? Do you agree with that, or do you kind of have a different opinion?
For most people, yeah. For most people, I would say yes. Now, if you go to one of those funds that run HFT strategies or really complex stuff, like Jim Simons, maybe he can explain, maybe he could explain in a few sentences, but then if you go into portfolio optimizations and stuff like that, where he says it gets more complex, I would I wouldn't say that he would explain in a few sentences, but for the 99% of traders, if they can't explain it in a few sentences, what's their edge, what they are exposed to, in a few words, they don't have an edge.
Interesting. I think I'd be inclined to agree as well. I think when I was first starting out, I was definitely of the mind of like, oh, well, if you could explain it, that simply, then everyone would have eroded your edge, which obviously nowadays we know is not really true. But yeah, I think I would agree nowadays is you should be able to explain your edge pretty clearly. The only times I'd say maybe that's more rare is if you're trying to explain why a portfolio works altogether, maybe. I don't even know if I could explain that in very clear terms, but I could explain every individual strategy why they work, like what main either risk premium or thing I'm kind of doing that is giving me
Yeah,
some sort of edge.
yeah, definitely. That's what I mean. At the individual strategy level, it should be very clear what the effect. You basically have to answer a few questions. What is the effect? What causes the effect? And how do you exploit it? 3 sentences for each. That's all you have to answer. And if you can't, then you are either getting lucky or you don't really have an edge.
Very well said. Well, let's get into your point because I know we discussed this last week of testing and production. I'll just let you kind of take away with it because I know you have a lot of thoughts on the topic.
Yeah. So testing in production. That's just the basic idea of everything that I try to do. If you are not like you see a lot of these people, even today I saw an article sent by someone, and you can clearly see that the person doesn't trade. And it's academics do have a place, right? They do generate a lot of ideas, and academics are important. But at the end of the day, the world is made of practitioners. It's people that are in the arena just testing stuff. The model that I run today, I said this a few times. It's like I didn't even have a backtest for it. I just knew there is momentum in this market. I should risk a few percentage of my account on every trade so that I don't get overexposed. I should use some variation of a trail, and that's it. And I deployed it. I didn't even have a simple backtest for it, and I'm still using it to this day. Obviously, I now have better simulations and stuff like that. But had I not deployed that model at the time that I had deployed, I would have missed on a bunch of returns. But I seized an opportunity that I saw. I got into the market and I capitalized on it. I didn't worry too much about the minutiae of the model. So I made money, and that's everything that I do is I see an opportunity and I test it. I go to the market.
Fair. The only thing I'd push back on that, and obviously, like we always try and have kind of constructive conversations, is do you think testing in production can be a bit of a survivorship bias, meaning that like if it works out, then great because you've captured those returns, but if it doesn't, then you could have tested and saved yourself some of those like drawdown, if that makes sense. What do you kind of think about that?
Yeah, I don't mean that people shouldn't have a backtest or simple simulation. I'm saying that if they see an opportunity and if they have reasonable experience and understand the risk and everything like that, spending months and months trying to come up with like the backtest that will launch their model, it might be a bit counterproductive because you don't really know if you can execute on it. You don't know the costs, for example, on small caps, on equities. You can run all the backtests you want. That's great. But at the end of the day, it will all come down to how much borrows do you have, the costs that you can do, and how much you can extract after all of those costs and constraints, right? And you can't really get, or at least it's very hard to get a true backtest for that. You can get the backtest for the direction of the trade that you take, but you can't really backtest for all those constraints. So it's all about does the market validate the idea that I have or not? And sure, you should have a backtest to understand the portfolio allocation that you should have and not bet too much.
Okay, I think I would agree with that. I think like I had a very similar framework in the sense where I always kind of tried to recommend, hey, like test something in live. So take some live samples, like maybe 50, maybe 100, depending on like how many signals you're getting, right? See if it actually works in recent markets because you're obviously doing those live samples. And then also that will give you an idea of like what the costs are like, etc. And then you can kind of run a proper backtest from there if it actually seems kind of promising. Because okay, maybe I'll get a bit of slack for this one, but it depends on the strategy. This is obviously very like nuanced, but there isn't much benefit to deploying a strategy that isn't working in recent markets, at least in my opinion, unless it is a core strategy type. So like, if I'm deploying a trend following system or, a mean reversion system and I'm adding it to a portfolio, yeah, 100%, it doesn't need to be like working peak profits, when I'm deploying it, right? But if I'm exploding something new, I probably want to see it working recently. Otherwise, it doesn't hold as much bearing of me like actually doing like a 5-year, 10-year backtest and then actually looking to then deploy it. Do you agree? Do you disagree? I don't know. Personally, I'm not like 100% certain on it, but that's at least my view.
Yeah, I think I want to be like careful saying that because I'm also understand that not everyone has the same level of experience, so I don't want people to go like
True.
test moving average crossovers on small caps, right? That's not what I mean. Is that if you have some experience and you see an effect, let's say that you know that some specific funds all at the same time do some portfolio rebalancing on some cryptocurrency, whatever that they are holding, and you know that those funds will hit the market with that liquidity at a certain time. You're not going to have a backtest for that, or at least if you're going to have, it's a very rough idea. Just better just position yourself against that flow and capture the return that you have there, and you'll see a bunch of constraints. Even today, if you want to talk about it, I had an example of such a strategy that I have no backtest for, and I just went into the market and tested it. And I think if you have experience, that should be, the market is the ultimate arbiter of truth, right? You either have an edge or you don't, and the market will tell you right away.
That's very true. Yeah, sure. Let's get into your kind of trade because I know you sent me a couple of screenshots. Obviously, we won't go into kind of specifics with it, but it seemed like a pretty amazing kind of trade. So tell us a bit about it.
Yeah, so today there's something in crypto. I'm not sure how aware the audience is with crypto, but we have funding rates on perpetual future contracts, right? Instead of rolling over like a normal futures contracts, you have these funding rates that every 8 hours or every 2 hours or every hour, depending on the exchange, they try to regulate the price of the contract with the price of the spots to keep everything in line. You can Google funding rates and you'll get a better answer than mine. Sorry, a more clear explanation than mine. But basically, the basic purpose is if the prices are too deviated, like if the contract is too deviated with the spot price, you pay a lot of funding fees so that it incentivizes traders to bring prices back to parity with each other. Okay, and so you can form an idea like when strategies get when perp contracts get very high funding rates or very low negative funding rates, you can position yourself to collect those funding rates, and sometimes they are 1% every 8 hours or 2% at the extremes every 8 hours. But there's a few constraints. For example, you can collect that funding rate. Let's say I buy long this asset and I start collecting negative funding rate, let's say 2% on a $10,000 position, let's say. So I'm expected to collect $200. But I still have to hedge my position. I don't want to have a naked long to some weird cryptocurrency, right? So when I hedge my position with a short position, I'm going to be paying the funding on the other exchange, and I'm also going to be crossing the spread every time I buy or sell the position and paying fees and everything like that. So it becomes a very not complex but hard problem to solve, because you have to pay a bunch of fees, a bunch of trading costs, and those 2% get diluted when you calculate the net return of the trade at the end of the rebalancing period, the funding period. And so if you're going to backtest something like that, let's say you're going to take the funding rates from the exchanges, the prices, you are not going to get that very easily. You're going to have to make a bunch of simulations that you are not going to accurately represent. When myself got into the market, put the positions on, and got all of this feedback directly from the market, just from trading it. And now I've saved all of these notes, for example, from this specific trade, and I'm going to do some testing around some ideas that I have for that specific trade. And maybe it would have taken me hours, days to get to that. And eventually I would have to trade the market anyways to get that feedback, because I couldn't in a backtest. So that's the idea behind testing in production. Sorry if
Super
I was a
interesting.
bit confusing.
No. I think you explained it really well. Like, okay, I'm gonna ask a bit of a noob question because personally, I don't trade this particular kind of like strategy or arbitrage. Does are the funding rates standardized, meaning that, like, as you mentioned, like 2%, would 2% always be extreme, or does it kind of fluctuate where you're testing it on that particular ticker, or like, I guess, coin in this case, or is it like, anything above 3% is like a really solid opportunity?
Yeah, it's always fluctuating. It's always depending on on the underlying contract to the spot price, or the underlying contract and some mark price that some exchange uses. And so it's always fluctuating based on that difference. And so even though, let's say you get a -3%, whatever funding rate, it doesn't mean that you'll get a 3% at the end of the funding period. It just means that right now it's 3% if the funding were to close. And so there's some assumptions that you have to make around that, and that's all the constraints that you don't see in a backtest. Like, yeah, you get 3% now, but is it in 8 hours? Is it going to be 3%? And if it's not, is it going to stick? Like, does previous funding predict future funding so that you can continue to be exposed to that position and collecting more funding, or are you just paying funding and being negative on that trade? So there's a bunch of constraints there. It's not as linear as collecting, like anything in markets, like we talked at the start of our conversation, right? You are being paid for uncertainty, and you are providing a useful service by providing liquidity to a market and putting prices back in place where they should be. But it's still uncertain and hard to do it. It's like a plumber trying to, fix leaky pipes. Yes, you're going to get paid for it, but it's a messy work. Same here.
Yeah, no, I agree. I think it's a good comparison. One other thing I actually want to ask about this, maybe I'm wrong with this, but this seems like a very narrow edge, meaning that size for this particular case is going to be very important for it to be worthwhile. Is that true, or could you do this with smaller size?
I mean, if you're going to be collecting 3% and doing it on $1,000 to make $30,
that's what I'm saying.
Yeah, you can still do it to gain the experience, but it's hard for me to make that argument because it will be hard to build capital that way.
Yeah.
But if you're doing like on $100,000 and you make $3,000 in a day, in a few days, in a day here and there, and you get these opportunities every now and then, it's a nice income.
No, okay, I think that makes sense. Because, like, I guess it kind of brings to the topic of you do get introduced to new sort of strategies as your account grows. Like, I do find it strange where people only use one particular strategy and they kind of grow the capital only on that particular strategy. Obviously, there are some rare cases, like, classic strategy types. I think that's totally applicable. It makes complete sense. But for more rarer cases, when you do get to larger and larger capital sizes, you really can allocate them in really interesting opportunities, kind of like the one you're mentioning here, right? Like, you do have different ones, I guess, a bit in small caps. Like, you can allocate them to, as a very simple example, let's say people were, made a good amount of returns shorting parabolics in small caps. Pushing huge size in parabolics, especially from a bit of experience, is very difficult. It is not fun work in the slightest. You'll have halts, you'll have incredible slippage, you have no idea where you're actually going to fill after that halt resumes, all those sort of things. So when you do to get to those sort of limits, you can just move over to kind of new opportunities. I know you've grown your capital a lot. Do you plan to move over to new opportunities as you're kind of doing with this funding stuff, or is this more just for general exploration?
Yeah, I do. At least some portion, a third or something of the funds. I'm not to also add some diversification to it, and if I can add another like income stream. And these strategies usually, they are strategies, but they are more like opportunities that come up once in a while,
Yeah.
And once they are there, it's just cash to be collected. And so it's a bit different than running a momentum model, for example. I know that I'll make returns over the long term, but the effects are more noisy, if that makes sense. Where in these type of strategies or opportunities, you see something and you get paid to collect that, even though it's very, like, it might be practically, if that's a word, like practically hard to do, because you have to put a bunch of money on weird exchanges and moving on wallets and stuff like that. So it's not so clear like opening a position and it's done. But when they are there, they are good opportunities to be collected. And once you scale, even like, let's say that scaling be beyond like 7 figures or 8 figures in capital, you start to get new opportunities that I see, like DeFi yields. For example, I just saw one today yielding like 25% on some stable coins just for providing liquidity to that protocol. Yes, you wouldn't put all the money in one protocol. There's a bunch of risks there, But if you have like 7 figures earning on average 18 or 22% or something like that, you have a very nice income for doing absolutely nothing other than providing liquidity. So
100%. This does actually remind me of one topic. I guess it's more applicable to crypto, but I'll try and apply it to kind of all traders. Is how much do you think you should withdraw from markets? Like, should you do it based on P&L goals? Should you do it based on time, so every 6 months, every 1 year, etc. Just because I've seen a lot of cases, and I bet you've probably seen even more than me, is that people will make a significant amount of money, whether it be a lucky trade like a meme coin or whatever in crypto, and then they will, for some reason, put all of that capital and put it on a yield on some sort of shady exchange. And in the case of like FTX or something like that, it can just disappear, and then you've basically withdrawn nothing, and you've just kept it all in the loop in crypto. This can also obviously apply in trading, where if you have a futures or small caps account and you keep on compounding and you never take anything out, ultimately you still have 100% risk on, in my opinion, because if you do mess up on one trade or you do get margin called for whatever reason, all that capital is going to be taken to fulfill that, right? Whereas as long as you've withdrawn some, at least you have some sort of protected, whether you put in long-term stocks, etc. But what do you think? Do you take out P&L every once in a while, or P&L goals, etc.?
that's an interesting question. I really don't know, because my focus has been more on just growing the capital and not taking as much. But it's really dependent on the person. Like, for example, I'm 27 years old. I don't have much responsibilities. It's like I said, if I lost everything tomorrow, I could work on McDonald's and make my costs, my living expenses, So it's really hard to say. It depends on the person. But if you've made a substantial amount of money, like for example, if you made, let's say, I'm going to give a random example. Let's say you made $2 million, right? And $1 million would set you up for the rest of your life. I would take those $1 million, put them, pay the house, whatever, put it in the market, earning some percentage, and that's your base. Like you don't need anything else. You don't need a job. You don't need anything else. You can just live off income, and then it kind of frees you up, because now you are able, on the remaining money, if you are experienced, of course. If it was not absolute luck, on the remaining money, you feel more free to take a lot more risk, and maybe that helps someone, so that they are not bound, let's say, to living expenses and having to take capital. And yeah, at least that's the way I see it. But again, different circumstances, right? I'm not giving any advice. This is what I would do. This is what, if I had $2 million or made $2 million tomorrow, this is probably my strategy of what I would do.
Yeah, no, of course. I think I view it in a sort of similar way. Like, I always find it fascinating talking with you over the weeks, because you're a lot more aggressive on compounding than me, which will probably, pay off in the long term. But
Or
I
blow up.
think we have that joke every once in a while, but we'll see. I personally, I have faith in you. I think you'll compound it like crazy. But for one thing I have definitely learned from you is the power of having your basic needs sort of met in some essence, right? Having a very secure base, even if that base is not very flashy or anything like that. And I think when I see a lot of people on YouTube, primarily, I guess, or maybe even on Twitter as well, I think it's more important as a trader to secure your base rather than having any sort of ego play and trying to be flashy, trying to have the watches, the cars, etc. Because both of us could probably afford a decent car right now, maybe a decent watch as well. But like, what's the benefit of it ultimately?
Yeah.
Like, most of the point of us is to try and have a very secure foundation to be able to provide for our loved ones and also ourselves, and then we can keep on compounding from there until where you have so much excess capital, it makes no difference if you spend 20k 30k on a watch, right? That's kind of the way we want to go into it. So yeah, I agree with you. I think for the most part you want to take off not too much, but you want to make sure that your first responsibility is getting that foundation, and then from there you can kind of just keep on compounding.
Yeah, completely agree. It also comes down to maximizing freedom, right? Yeah. Imagine making a substantial amount of money, and then one day you lose it all and you have to go back to work. I don't know, that would be really hard to do. And so when you have that in mind, the Porsche or whatever isn't so flashy anymore. You don't care anymore. It's like you maximize freedom. You work on what you want every day. You do your own work. You don't have to schedule vacations with the boss, because then he doesn't allow you because there's a colleague that has vacations at the same time, blah blah blah. Like, that's the most important, to spend time with family, being able to, at least for me, like, and when I have those thoughts, because I also have those thoughts, like, hey, I wanted to buy this car or maybe that watch. Sometimes I have those brain dumps, let's say. It's like, and then I think about that idea of maximizing freedom, and it goes away quite fast. Yeah, if I had $10 million in the bank, sure, I would buy a Ferrari just to test it out. Why not? I'm not going to say I wouldn't. I like cars. I would. But that's not the case, and I prefer to compound it in the market. And maybe eventually one day I'll hit those figures that I have as goals, and maybe I'll be able. If not, great. If yes, awesome. Also, it is what it is.
Completely agree. Do you want to go over to the last point, or do you want to end it there?
I think we saved the last point for the next day. What do you think?
Yeah, no, I think that sounds good. We'll save the last kind of note for next week's, but this was a really good episode.